Welcome to the Investors Trading Academy lecture series. This series is on preparing to trade in the financial markets. The series contains 6 lectures. You will start off learning the basics of the financial markets and then move on to learning and understanding technical and fundamental analysis and how to read charts. From there, we will move on to trading and marketing and making smart decisions. Each lecture will slowly prepare you to move forward. So please take the lectures in order. And I would also appreciate greatly if you could subscribe to my YouTube channel. Just hit the bell icon below or the subscribe button. It's very important to me, and I promise you we won't bother you with anything. You get a ping just when I upload a new class. That's it. And today, this is lecture number 1 of our 9-part series. So let's start out with some general knowledge before we go into the specific types of financial markets. When looking back at data from the 1600s to today, we have discovered that the history of the stock market over the past 400 years can be broken up into 4 distinct eras when economic and political factors affected the size and organization of the stock market in different ways. Politics and economics define the limits of financial markets by determining whether companies can exist in the private or public sector, by controlling the flow of capital in financial markets, and by determining the level of regulation that companies face in maximizing their profits. The first era covers from 1600 to 1815. Yes, 400 years ago. And back then, the financial markets funded government bonds and funded the actual government. The government collected taxes, or the wealthy landowners collected taxes, which then went to the government, and the kings were funded by their nobles. All of this started to change in the 1600s with the British East India Company, which was first established. And it made some changes in the way the world did business. A financial revolution occurred in 1600 when the Dutch East India Company and the English East India Companies were established. The Dutch East India Company was founded in 1601 and continued to operate until 1799. By investing in several ships, merchants could reduce their risk. The innovation of the Dutch East India Company was to vest ownership in the company and not in an individual voyage. This provided economies of scale, and by creating perpetual life for the corporation, allowed capital to flow from one voyage to be reinvested in other voyages. What is important about the financial revolution of the 1600s was that it established the principle of founding corporations that could issue shares which did not expire. And then for the next 200 years, the financial markets had very little numbers of securities and didn't do so much. No, there weren't any big changes. But then the second period can be classified from the 1815s to the 1914. Well, there's several things that happened. The end of that period came because what happened in 1914? World War I, which changed everything, the way people thought about other people, the way people transported things, and how the world functioned. In 1815, things also changed. That's when we started to see the first canals and railroads. People could then start moving globally. Goods could start moving globally. And this is when investors discovered that transportation stocks could provide reliable dividends as well as capital gains. For the next 100 years, investors had the opportunity to invest in thousands of companies that could generate capital gains as well as dividends. Financial markets became globalized, and the transportation revolution enabled the global economy to grow. Then it wasn't again until the 1980s that the equity markets became globalized once again, with deregulation and privatization sweeping over the world stock markets. The poor performance of markets and the economy in response to OPEC oil crisis of the 1970s brought the role of government in regulating the economy into question. Privatization swept over the capitalist economies, and the former communist countries opened world stock markets and began to integrate with the world's financial markets. This is also the period when speculation began to grow. Today, financial markets are driven by technology, which makes it easier and cheaper to integrate financial markets into a single market. The foreign exchange market is a global market that trades 24 hours a day. Money is digital and moves around the world on electronic networks. At some point in the future, equity and bond markets will trade 24 hours a day in a single market. How long it takes to reach that point depends upon technology and politics. The internet will enable markets to become more integrated in the future. Now, this may seem like it's out of order to you, but we're going to talk about CFDs. Because CFDs are one of the newest instruments that you can trade on the markets. But it's the result of the growth of the internet and the change in globalization. And we're going to take a look at every different way you can trade. We're going to look at ETFs. We're going to look at options. We're going to look at futures. We're going to take a look at the commodities market. We're going to look at the stock market. We're going to look at cryptocurrencies, because you have to understand each one of those markets. But CFDs are one of the few instruments that allows you to trade almost every single market. It's a contract for difference is a contract between two parties typically described as a buyer and seller, stipulating that the buyers will pay the seller the difference between the current value of an asset and its value at contract time. It is one of the fastest growing derivatives in the market. Trading contracts for difference is a way of speculating on the financial markets that doesn't require buying and selling of any underlying asset. CFD trading is defined as the buying and selling of CFDs, with CFD meaning contract for difference. CFDs are a derivative product because they enable you to speculate on financial markets such as shares, forex, indices, commodities, ETFs, bonds, and cryptocurrencies without having to take ownership of the underlying asset. And this is one of the reasons I put it first, because regardless of how you want to trade or what you want to learn, we have to understand how we trade or speculate in these assets. And there's many ways that you can speculate. And like I said, we're going to go over each different way. Instead, when you trade a CFD, you're agreeing to exchange the difference in the price of an asset at the point at which the contract is open and when it is closed. See, with CFDs and most derivatives, because you're not taking ownership, you're not really concerned with the value of a company. You're not really concerned with the value of the orange juice. You're not really concerned with where the euro is going to be based on the economy next year. What you're concerned about is only the movement or the short-term movement of a particular asset. So CFD trading enables you to speculate on price movements in either direction. Okay, so I've said what I have to say. Now let's talk about the individual markets. So let's start out with the introduction to the world of currency. Now, the international currency market is a market in which participants from around the world buy and sell different currencies. Participants include banks, corporations, central banks, investment management firms, hedge funds, retail forex traders, and investors, and us. The international currency market is important because it helps to facilitate global transactions, including loans, investments, corporate acquisition, and global trade, and opens up a chance of speculation. The international currency market is the largest financial market in the world, with an average daily trading volume of $5 trillion. In this market, transactions do not occur in a single exchange, but in a global computer network of large banks and brokers from around the world. The currency market, or forex exchange market, was created to facilitate the exchange of currency that is necessary as a result of foreign trade. For example, if a Canadian company sells a product to a U.S. company, it will want to be paid in Canadian dollars. The U.S. firm would need to facilitate a foreign exchange conversion through its bank to pay the Canadian company. The U.S. firm's bank account would be debited in U.S. dollars, and the U.S. bank would transfer the funds to the Canadian company's bank. The funds would be converted to Canadian dollars at a preset exchange rate and credited to the Canadian company's account. Now, this is a very general explanation. Today, we have money transfer companies to do all this instantaneously, and I can send dollars from the U.S. and give it to you in euros, and I can see right online what I'm doing, and it's in your account in seconds. And we have money transfer companies who don't use banks today at all anymore. But this is the basis. Now, there are 5 major popular forex pairs. Okay, when it's talking about trading, we're talking about used in the world, because these are the most powerful currencies, and they include the US dollar, the British pound, the euro, the Swiss franc, and the Japanese yen. These are the so-called majors, especially when we're talking about currency pairs. Because in the currency market, no matter what you're doing, everything, whether you're buying currencies, paying a bill, like we talked about the Canadian dollar and the US dollar, that is a US dollar, Canadian dollar. It's a pair, because the value is only achieved by the value of one currency to another. So when we're talking about speculating in the markets, okay, we're talking about the major currency pairs. The major currencies, regardless of what you're doing, were the ones we just looked at. But the major currency pairs are the euro dollar. Okay. It is the largest currency pair in the world. Then it's followed up right after it by the US dollar, Japanese yen. Then we have the pound US dollar, the USD Swiss franc, the US Canadian dollar, and the Australian US dollar. The US dollar is considered the world's reserve currency since the US has a stable economy and financial system. Many products, commodities, and investments are transacted in US dollars, which is why it's involved in most major transactions and currency exchanges. Countries that don't have a stable market or currency exchange rate might opt to trade in dollars to attract investment or facilitate trade. For many, many years, and I think it's still basically today, even though the Chinese yuan or the old renminbi is a quite powerful currency today, every contract negotiated with the Chinese is negotiated in dollars. Oil is only traded in dollars. Gold is only traded or bought and sold in dollars. It can be converted to euros or pounds, but gold is always talked about in dollars, and most contracts to buy and sell actually are in dollars. We also have in the currency market what's known as commodity pairs or commodity currencies. And these are currency pairs from countries with large amounts of commodity reserve. Okay. So you're saying, why isn't the US dollar a commodity pair? It isn't. It's a major. Okay. These pairs are highly correlated to changes in commodity prices since the countries produce and export various commodities. Traders and investors looking to gain exposure to commodity price fluctuations often take position in commodity currency pairs as a proxy investment to buying commodities. The commodities pairs include a pairing with the US dollar with the Canadian dollar. Why? Canadian economy is based on oil exports as well as gold. Australian dollar, they're a major mineral exporter. The New Zealand dollar, their whole economy is based on commodities. The Russian ruble, the Brazilian real, and the Saudi real, Saudis are all based on oil, are also currency sensitive to price commodities. Commodity pairs offer benefits to investors because they are among the most widely traded currency pairs in the foreign exchange market. Foreign exchange trading is the act of taking a position in the exchange rates of various currencies. Forex trades involve buying and selling foreign currencies at the prevailing exchange rate with the goal that the rate will move in the investor's favor. Okay. Now we go on to what's called exotic. And a lot of people hear the word exotic and they just think, oh, they're little tiny countries or there's things you don't want to buy like exotic animals. Okay. But they're not. exotic currency pairs include one major currency alongside a currency from a developing or emerging nation. For example, an exotic foreign forex pair would be formed when an exotic currency such as the Turkish lira or the Hungarian forint is paired with a major currency such as the US dollar or the euro. So we have exotic pairs, the US dollar, Turkish lira. We have the Turkish lira against the Japanese yen, the euro against the Czech koruna, okay, or the euro against the Mexican peso. Whenever you have a major and is paired with a third world or emerging nation currency, it's known as exotics. And you need to understand the differentials of what they're doing. If somebody's talking about, oh, the exotics are doing this, or we expect this with these the exotic pairs, or when you're trading pairs, you'll find that the spread or the cost of trading exotic pairs is a lot higher. So all currency trading is done in pairs. Unlike the stock market where you can buy or sell a single stock, you must buy one currency and sell the other. Again, we talked about the example with the Canadian dollar, US dollar. If it was reverse and you were a US supplier selling to a Canadian company, you would quote him in US dollars, but his bank account would be in Canadian dollars. When he had to go pay you, you wanted your money received in US dollars. And he would then have to convert his Canadian dollars to US dollars. So he sold his Canadian dollars, bought US dollars to deliver to you. One of the easiest ways I can tell you to imagine it is you're going on vacation. You live in the UK, you're going to the Eurozone, so you have pounds and you need euros. So you go to the commission store and you say to the guy, I have 1,000 pounds, I need euros to go over to where I'm going on vacation. So you're selling him your pounds and you're buying euros. And he gives you a rate for that. When you come back and you have euros left over, you go back to the commission store. And now what are you doing? You're buying pounds and selling euros. Now most currencies are priced out to the 4th decimal point, and that's called a pip or a percentage in point, and it's the smallest increment that that currency can trade in. When you trade forex, you sell one currency for the other, and they are considered though as one unit. The base currency is the one on the left, and the non-base currency is the one on the right. So in the euro US dollar, the euro is the base currency and the non-base one is the one on the right. We could be trading the US dollar euro, which has just the same value, but it tells you which is your base currency and which is your non-base currency. So usually the pair is quoted as above, the euro dollar at 117.8. which means for every euro you buy, you sell $1.17. Inversely, you have the US dollar euro, which is quoted as 0.848. You would divide 1 by the original amount to figure out. It's just the inverse. And this means you sell $1 to buy 0.8488 euros. So let's talk about some basics you need to know about trading. Online trading involves the trading of securities and other assets through an online platform. Online trading portals facilitate the trading of various financial instruments such as equities, mutual funds, commodities, currencies, and more. Before, you had to talk to a middleman. You had to call your stockbroker on the phone, listen to him, you had to deal with him, and then he would write up your trade and he would send it over to the wire room, and the wire room would send it down to the floor, and somebody would execute it at the floor. Today, if you're not lazy, you can go on your online platform, click a couple buttons, your trade is done, the asset's yours, and you're out of it. You have greater control of your money. There's no need to call or message your broker unless you really must. Today, you execute your trades with a broker who is basically a platform provider, giving you the technology to execute the trade on your own. A broker also provides education and information. They do not charge a commission in most cases anymore, and they do not give advice. Today, brokers make their money on the spread. Okay. We'll go back to the old commission store. Used to be years ago when you would go on vacation, you'd go in there whether you had 1,000 pounds or you had 1,500 pounds. The guy would tell you, my commission is 200 pounds. Didn't care whether you were trading, going away and using 1,000, 2,000, 3,000, he would charge you a commission and he would give you the best rate possible. Today, they charge a spread. If you have gone to a commission store recently, you see we'll buy pounds at this price, we'll sell pounds at that price. The difference between the buy and the sell rate is actually what's called the spread. And so today, your cost is a lot cheaper because it's only based on what you're exchanging. And this is how the commission shops, as well as brokers, as well as everybody, makes their profit. So you have a sell and a buy price, or a bid and an ask price, and the difference is called the spread. Okay. Now, there are some other things you need to know when you're dealing with CFD trading or a lot of other markets today, and that's called leverage, which means that you can gain a larger exposure or a larger position without having to commit to the full cost at the outset. Because you're not taking delivery of something, nobody's giving you something, so nobody's having to technically give you a loan or give you credit. So what they're doing is you're being allowed to trade more than you can afford to pay for. So say you want to open a position equivalent to 500 Apple shares. With a standard trade, that would mean paying a full cost of a share upfront. With a contract for difference and other types of derivative trading, on the other hand, you might be able to only put up 5% of the cost. So hypothetically, if Apple was trading for $100 and you wanted 500 shares, what would your cash investment have to be? Well, if you were taking delivery of those shares, 500 times 100 is 2 more decimal points over, or $50,000 you'd have to have. But because you're not taking physical delivery and you can't do anything with those shares except buy them and sell them, you're asked to put up a 5% cost. So on a $50,000 value of those 500 Apple shares, you're asked to put up 5%. Okay, 5% of $50,000 is $2,500, correct? Or $250. 50,000 times 10% is 5,000. 50% times 5% is $2,500. And you're controlling those 500 shares. Doesn't mean they're issued. They're never issued your name. You never take delivery. You can't take them to the bank and take out a loan against them. They're not an asset. Okay. While leverage enables you to spread your capital further, it's important to keep in mind that your profit and loss will be calculated on the full size of your position. In our example, that would be the difference between the price of 500 Apple shares at the point you open the trade and at the point you close it. So in other words, you open the trade for 500 shares of Apple at $100 a share. The value of the trade is $50,000. When you close your position, if the value of the trade was $47,000, you would owe $3,000. But if Apple shares had gone up and the value of your trade was worth $55,000, you would have made $5,000. Now the margin is the deposit. That's the opposite side of leverage. The margin is the 5% that you'd have to put down. It's not a cost. It's simply a deposit. It's a down payment. No, but it also magnifies your risks as well as your possible losses. So you have to be aware of controlling your risks. And we do that by using something called a stop loss. A stop loss order is an order placed with a broker to buy or sell a specific asset once the instrument reaches a certain price level. A stop loss is designed to limit an investor's loss in a position. Okay, let's go back to the Apple shares. You bought the Apple shares for $50,000. You had a 5% leverage. You put down $2,500. Okay, that's your technical part of putting the trade. But you as an individual know I can't afford to take a loss more than $1,000. Although I think I can make $5,000. So that would give you a 5-to-1 win-loss ratio, because your target would be Apple moving up to $105, but you would have to leave the market if Apple fell to $98 because you couldn't afford a larger loss. So you set up a stop loss at $98, telling the system, the platform, that if Apple falls below $98 to close your position because you can't afford to take a loss anymore. It means you don't have to sit there watching the computer all the time, and if Apple dips, it closes out your marketplace. And you have to decide what you can risk, because too many people come into the markets, whether you're trading CFDs, options, whatever you're trading, and don't understand the risk, or they say, fine, I can risk $1,000. I'm going to make 5,000. But it doesn't kind of work that way so simply, because you also have to take into effect, Apple dips when it's going up and down. It doesn't move straight up. And Apple might dip as low as 97.50 before it hits 105. And you put your stop loss at $98 because that was all you can afford to risk, because you were sure it was going to go to 105. Okay. So you have to always be aware of limiting your risk and understanding what the markets might do. Traders or investors may choose to use a stop loss to protect their profits. It removes the risk of an order not getting executed. You can also use a stop loss to protect your profits. So say Apple was moving at 101, 102, 103. You could move your stop loss from $98 up to 103. That means if Apple fell below that 103, it would close out your position. Well, 103, when it closed your position, you had made $3 per share, or you had made yourself $1,500. So for today, that's a wrap. But this gives you something to think about. We'll go on to lecture number 2, where we're going to go deeper into each of the different kinds of markets. And we'll start looking at the basics of trading. We're going to look at the understanding of financial markets. We're going to look at technical analysis and fundamental analysis. And that's all before we get down to building strategies. But we have to get all the basics under our belt. So thank you very much for joining us today, and we'll talk to you again real soon.